Welcome to The Money Runner. I'm David Nelson, your host. I had an entirely different theme for the start of this show. I wanted to talk about my target for the S&P 500 next year, where the rest of the street is coming out on this, Goldman Sachs, Morgan Stanley, Bank of America. But I thought I would just pivot for a moment and talk about Nvidia's earnings, which were released Wednesday evening. Stock was initially down. All in, it was a really great quarter, but this stock is, come so far in the last couple of years. I guess investors were looking for a little bit more. When I dig down into the quarter, look, almost every metric was a standout. Certainly a top and bottom line beat. However, the growth is slowing, as you can see in this table right here. If you can call that slowing, it's slowing down to about 50% growth, top and bottom line growth next year, but that's certainly down from over 100%. Some key things I heard in the call, and maybe the one statement coming from the CFO that probably held up the stock more than anything else. Blackwell demand, which is their newest product, their newest chipset, exceeds supply for the next few quarters. So that was good news. Some other good news was that data center growth, or what they call data center compute, was up 22% sequentially. So all of this on the surface sounds good, but we were sitting on the desk and asking ourselves the question, is Nvidia too big to fail? Or maybe more important, is the AI ecosystem itself too big to fail? Are we counting too much on it? Because it is certainly a major force in the engine of growth for our economy. The markets, we're certainly pricing a lot in. I'm using it every day. And maybe the most notable thing on the call was the CFO saying that virtually every S&P 500 company, in one way or another, is a customer of Nvidia, either directly or indirectly with a large hyperscaler that spends billions of dollars with Nvidia every year, helping companies, build out their AI footprint. Nevertheless, this better work because we are really putting an awful lot of capital into this. The CapEx spend at these large hyperscalers is gargantuan. And I guess what we're going to need to see is the return on investment, what they call the ROI. Are they being rewarded for this capital investment? Nevertheless, these are questions that need to be answered. Because when you look at this chart here, you're looking at the S&P 500, and that top, I guess what you call orange line, going back 2 years, you can see that's earnings. That's earnings estimates. Blended earnings, which is looking 6 months forward, 6 months backwards. And as long as that line is going up, generally the direction of the market will be up and to the right. However, when we expand that a little further and we add some more data here, you can see that during that time frame, that 2-year time frame, which is really the entire bull market from the bottom of 2022, earnings have grown about 18%. But valuations, that PE on the bottom, have grown about 28%. So we're getting a lot of what I call multiple expansion. We're paying more and more for each dollar of earnings. And therein lies an important question for ourselves. Are we overpaying for this growth? And that's a question we're going to have to answer. There's some things that could cause that rather could support that. Rates could be coming down. The alternative asset class, risk-free rate, is that coming down? That was part of the thesis for the last couple of years, seems to have stalled. There could be the productivity boom that I brought up on this show. That could be driving valuations higher, or at least supporting valuations at a higher level. I think that's in fact happening. But the more likely scenario is the market is getting pretty excited about the Trump trade and the idea of deregulation and what that's going to mean for profitability of companies, and the whole idea that we're going to probably upend Washington and get rid of a lot of waste and fat. The Doge factor, which I've talked about, which is Elon Musk and Vivek Ramaswamy. They laid out in the Wall Street Journal how they're going to do this. Pretty exciting stuff. And I think in part, is part of the reason the market is pushing as hard as it is to the upside. Nevertheless, when you invest capital, you have to understand where you've been and where you're going. So all in, you're going to have to answer this question: what's working, what isn't, and what's next? Welcome to the Money Runner. I'm David Nelson. All you had to do was stay invested. I wish I said that, but that actually came from David Kostin, who's one of the strategists at Goldman Sachs. It came out in a recent research note, and it's a true statement. You know, despite all the concerns we had this year and all the various things that could have gone wrong, whether it was Ukraine, China, the potential for a recession, the jobs market rolling over, which didn't happen, inflation roaring back, which didn't happen. All of those concerns you could have put off to the side. All you had to do was stay invested and ride it through. And it's not that easy sometimes. We had a call recently here at Belpointe, and one of my good friends, Neil Azus, who's portfolio manager and founder of Rareview Capital, he pointed out, as a portfolio manager, sometimes one of the hardest things to do is to do nothing and just let your investments ride. And clearly that was the better choice this year. Hard to do, but it's pretty easy in hindsight. So let's talk targets. I said I wanted to talk about my target, which I put out a couple of weeks ago. You can see on this list here, I probably come in at number 2. My target was for 68.50 for next year. And I based that on a really simple factor. I took the estimate of the S&P 500 at the time, which was 274. I put a 25 multiple on that, 25 times 274. I hope that's the right number. Let's find out. Let me get out my trusty calculator. 5274. Yep, 68.50. All right. That was my target. And I based that on the multiple rising because the productivity boom that I think is taking place, in large part because of artificial intelligence. I'm using it here at Belpointe. You're probably using it home. You can bet every Fortune 500 company has a project going on right now that's going to help boost their productivity. That's how I got there. Other strategists use a different metric. I think Ed Yardini's above me. He's at 7,000. Brian Belsky at BMO comes in at 6,700. And David Kostin, who I just mentioned, is at 6,500. They'll all adjust these numbers as the year goes on. But let me just share a little insight. I've been doing this for a while, and over the last couple of decades, I hear 100 targets every year from analysts. And the best thing I can say about it is it's just this side of meaningless. Because in the end, we don't know what we don't know. All right? That's my statement. Any number of things can go wrong over the next year. Something we haven't even considered. It could be something in Ukraine. It could be a nuclear event. I mean, Putin just put out a new nuclear doctrine. Hypersonic missiles are now being fired over there. It could be something in Washington that we haven't even considered. The inability of the Trump administration to get through some of these exciting programs that they're about to initiate. A lot of things can go wrong, and they always seem to do. So you have to have a plan of action. What do you do? Sometimes you have to respond, and you have to respond quickly. Sometimes waiting weeks for an event to pan out, by the time you make the decision and pull the trigger, it's too late to do anything. But all of those things are things that could go wrong. So it's fun to put a target together. I do it. They do it. I guess we all do it to a certain extent. But you have to understand that your plan may just not work out. I guess I'm only thinking of it right now. I'm thinking of Mike Tyson because I just watched that fight, which was maybe less than expected. But he did have a phrase that always stuck with me. He said, everybody's got a plan until you get punched in the face. And you never know when that's going to happen. So sometimes it's better to be reactive rather than proactive, because if you're too early on what you think might happen, that can be just as costly in here. So what are some of the things that could change? Well, here's one thing that's already changing. So much of our trading last year and the year before was really based on the idea that the Fed was going to go into a dramatic cutting cycle. Now, it took a long time, came later than expected, and we got the first Fed cut back in September, 50 basis points, and hence we've got another 25 since. But just 4 weeks ago, we were pricing in about another 150 basis points of cuts between now and March next year. Not that far from now, all right? You look today and you look at Fed Fund futures, and we're going to be lucky to get 25. Markets are pricing in maybe 25, maybe 50 could happen. That's a lot less, and that takes out one of the legs of the stool, because we said one of the things that permits us to spend more on stocks or to increase the multiple that we pay for earnings is lower interest rates. Well, what if those interest rates don't go any lower? We're going to have to be prepared for that. We're going to have to ask ourselves the question, why is that? Is that happening because growth is really accelerating? That's the good news. Or is there something else going on? And it's probably a little bit of both. I think what you're going to look at for a normal yield curve between now and the end of next year, I think the short end of the curve, I think the Fed will cut rates somewhat, but perhaps they're only going to get to maybe 4. That might be it. And if they get to 4, then you could be looking at 5.5% on 10-year yields, possibly even a little bit higher. I think the demand for U.S. Treasuries has fallen. I think a lot of foreign actors, a lot of foreign countries, a lot of sovereign states that were traditional buyers of U.S. Treasuries are less likely to do so. Certainly China would fall into that matrix. Add the fact that BRICS nations are contesting the U.S. dollar as the world's reserve currency. They have their own mindset of what they want to do. Increasingly, we're seeing a lot of non-dollar transactions. BRICS is becoming a formidable force. And right now, the combined GDP of BRICS surpasses that of the United States. So it's not something we can just ignore here. Other things that are changing, and maybe this was the biggest surprise for me this week. I put so much stock, maybe over the last couple of years, in the health of these large cap secular growers, the Magnificent Seven. And hands down, they delivered. They've had an enormous performance in the last couple of years. And we've seen some stabs at the rotation trade of small cap stocks starting to outperform for a period of time. Mid cap stocks would outperform, but it always seemed to fall, to the back of the bus. Just didn't last in here. Trump trade came around, and we could see here since the Trump trade, since the election happened, and under the mindset that the Trump trade would mean more cyclical growth, better news for small caps. Small caps certainly did rally, but you look on a year-to-date basis, certainly the S&P 500 is the hands-down winner. This next chart expands that chart by just a couple of months. All right, I'm only taking it back to Thanksgiving last year. I looked at this picture and I said, Mike, that's got to be wrong. I actually redid this chart 3 times before I was convinced that what I was seeing was true. And what you can see here is small caps are now the leader, all right? From laggard to leader. Just 2 months ago, this was the back of the bus. Now it's at the front of the bus. Right? And we have to recognize that and understand that the earth is literally shifting under our feet, and we're seeing new trades develop here. So we're going to have to judge whether or not this is a sustainable course, because if we don't recognize it, we might, as portfolio managers, start to underperform what our competitors are doing. So I'm taking this to heart. and I'm going to have to really dig down into it. I'm probably going to have to bring my market cap down. I'm probably going to, since I run predominantly a large cap portfolio, I'm probably going to have to shift my market caps down and start looking for some smaller names, because this trade seems to have legs. But it's something we're going to have to examine over the next days, weeks, and months. I expect next week to be something of a quiet week, maybe the first day or two, but by Wednesday it's going to wind down pretty hard. And then, of course, we're into the Thanksgiving break, a shortened day on Friday, and then back in earnest on, we'll be trading in December, and we'll close out this year, and hopefully we can close out this year on a good note. I'm going to leave it for now, because I really, out of charts, out of time. But if you'd like more information on the Money Runner and David Nelson, or just would like access to the charts you saw on today's podcast, or you'd like access to maybe some of the network appearances that I have on some of the various networks like Bloomberg, CNBC, Fox Business, etc., go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is The Money Runner.